In this video, I will share the 23 best trading strategies that I have come across over the last 14 years of being a trader. And we're going to cover trend following, breakouts, reversals, pullbacks, continuations. I will include a multi-time frame trend analysis. We're going to look at price action, technical analysis, and we're going to answer the question, what is the right time frame and the best strategy for you? So without wasting any time, let's just get right into the first strategy, and you will see I will always tell you what kind of strategy it is, what are the tools we are using, what is the idea behind it, and how do you get into a trade. So here we are now on the 1 hour time frame, and I'm using the blue line, which is a 100 period moving average. It's an SMA from the daily time frame. And what you basically want to look for is a trend direction change. So here on the left, you can see the market was trading below the moving average. Then there was a bigger push, which led the price to go above the moving average. And then what we want to look for is the first retest of the higher time frame moving average. So the first time the market is then coming back into the moving average. We are not going to just blindly trade a moving average retest here, but we are looking for signs that the market is slowing down at the moving average. Maybe we can even find something like that here. We have a very, very nice pattern where the market is slowing down with a triple bottom. We have a trap, which I will cover more later. And then you are looking for a breakout out of the range, away from the moving average, and this is usually how you get in. As I mentioned at the end, we have a strategy Q&A, and there I will talk a little bit more about limit versus market orders and how to get into such trades. But this is the general idea. You wait for a break of the higher time frame moving average. You wait for the market patiently to come back here. Then once the market is back at the level and at the moving average, you're waiting for any signs of patterns slowing down, and then you wait for a breakout. Here we have another example. The market broke from the top above below the moving average here. So the market, you have to imagine, what does it look on the higher time frame now that we are on the 1 hour? On the higher time frame, the market was trading above the moving average, so it was in an uptrend. Then you wait for the market to change direction. You go from uptrend to downtrend when the price has broken a moving average. Then you can see the market traded away for a little while, came back into the moving average here, came back into the previous high as well, retested the moving average, retested the previous highs, couldn't break above it, and this is where you then look for trading entries into the new trend direction, because we always want to trade with the higher time frame trend direction. It just makes for much smoother trades. The price will usually move much faster, and you will usually be able to book profits much sooner if you go with the higher time frame trend. And we can use the 100 period daily moving average to help us find that. Another example, the market is coming back into the moving average from underneath. Here you have a double top pattern. You also have a very, very nice break and retest pattern. And I've prepared a few variations of how we trade break and retests later on. So here you can see we have a previous support point here and here. And on the breakout, you have a retest. The market is coming back into the previous breakout area and is retesting it from underneath. So some traders prefer breakouts, other traders prefer pullbacks. There's not really one or the other's better. In my experience, what I've seen, what happens is when traders trade breakouts or pullbacks is usually they try both to see, okay, what is more compatible with their way of thinking, what is more compatible with how they look at the charts, how they view the charts. And I personally prefer more the breakouts, but over the last few years, I have come to appreciate also the pullbacks. So we will talk about breakouts and pullbacks more. And some traders even combine that. Maybe you trade both the breakout and the pullback. Maybe you missed the initial breakout and then the pullback and the retest is giving you a second option to trade that. Next on our list is the alligator trend following, and I think this is also called the Williams alligator if you go to TradingView or if you just want to look it up. And basically what you have is a 3 moving average trend following system, and we are using I think it's the 13, 8, and 5 period moving average. You can see we have a green, red, and blue line. And the idea is that those 3 moving average represent the mouth of an alligator. And what you want to do is you wait for the mouth to open of the alligator. And what this means is that obviously the 3 moving averages are separating. And this means that the momentum is accelerating. When the moving averages are very tight, when the mouth of the alligator is closed, it means that there's no momentum. The price is usually trading in a very tight consolidation. And when the mouth opens, then you are looking at a accelerating or starting trend. So here we can see that we are very early in a range market. So first the market was contracting, it was trading in a range. And what I found during my back testing is the alligator is best used with a combination of also a breakout approach. So what you do is you look for a tight consolidation. In this example, we have kind of like a triangle. You can see here we have a resistance area connecting the highs. And we could also connect here the lows, and then this will give us a triangle. And what you want to do is you wait for a market to break out of it. And you also want to confirm that the alligator is starting to open its mouth. And then you can use the moving average system here, the alligator, to keep you in those trades. You have a few options how you're going to use it. First, I have read what people doing is they wait for the mouth to close. So what this means is that the green and the red area or moving average are touching again. Some even wait for the tongue, which is the red area, the red moving average, to touch the lower jaw, which is the blue one. So you have a few options here how you can use the alligator moving averages to help you stay in those trend following trades. Another example, we are here in a range market. We have 2 previous highs which give us this range. You can see we could again connect the lows to give us a triangle, and we wait for the market to break out of it. It's very important that once you have to find such a range, you always want to wait for the market to get out of it. Trading within those ranges is one of the biggest mistakes that I see amateur traders do. You're going to lose a lot of money trading in those ranges, so learn to sit on your hands and wait for the actual breakout. You can see then the moving averages are nicely separating, the alligator is starting to open its mouth, and then you can see the market moved higher quite nicely. We have a alligator trend following breakout, so you can see the market is already coming from here an uptrend. It was moving higher very slowly. And then you are waiting here for a triangle. Previous resistance is turning into support twice. We can connect the highs here at the top as well. So this gives us this nice triangle consolidation. And again, we are waiting for the price to break out. Here you can see this probably wasn't the greatest entry because here the alligator hasn't opened its mouth. So you would stay out of this market and wait a few candles later, probably not until the market was here, where the alligator is really fully opening its mouth, and this is then helping you to confirm that you are really looking at a high momentum trending market. So a few ways how the alligator and the moving average in general can help you improve your decision making. Bollinger Band spikes. I've traded Bollinger Band spikes for years and years. There are a few ways how you can use them. I have first included a continuation spike strategy, and then later we are also going to take a look at a reversal, which is one of my favorite ones. So we are technically here in a downtrend. The market is coming here from the top, was trading in a range, moved lower, a very nice trend following move here out of this range. Then you can see the market entered another sideways phase, and it's very important that you understand that the market will always go in those waves. It's never going to just shoot up in one straight line, but there's always this interplay between the buyers and the sellers. On a downtrend, you will see the market makes an initial move down. You have a range market, which is then a consolidation, and then the next trend following leg is going to follow. And what you would like to see is a Bollinger Band spike within a consolidation. Here, for example, you can see that the market was trading sideways and we have a spike. What does the spike actually mean? The spike means that the market tried to break out into a new high and outside of the Bollinger Bands, and the market was rejected. The breakout failed. The breakout immediately fell back within the Bollinger Band range, and this gives you a big heads up that there was an attempt of the buyers to drive the price up to reverse this downtrend, but the buyers failed. So it shows us that there's a lot of selling pressure somewhere hiding here inside, and probably the sellers are loading up here behind the scenes, and that should give you a big heads up, and then you just wait for a breakout out of the range into the direction away from the Bollinger Band spike. Here we have a Bollinger Band spike reversal, and there are a few components that are coming together here. So first of all, this is happening on the US dollar Canadian, which is obviously a Forex pair, and Forex is generally considered a mean reversion market. So this means that in Forex, you usually see that the price is trading around a moving average. And this means that trends don't last as long as they do in stocks, for example. So what I do is in my trading, I wait for the market to show me a very, very strong trend. And if I'm not in the trend, I will get ready to find reversal opportunities, because in Forex, the longer a trend is going on, the higher the likelihood that it's going to reverse, and the higher the likelihood it's going to reverse quickly and strongly. So what I do is then I wait for Bollinger Band spikes. So something like that here, we are coming from a huge uptrend outside of the Bollinger Bands. Very important to note. The market is able to close outside the Bollinger Band, which is a very, very strong signal. But then here, at one point, the trend failed. The price tried to break out, continue its path higher, but it failed. The market fell back inside of the Bollinger Bands with this nice pin bar. And this is then the moment, and I will show you that later with a multi-time frame strategy that I've also included. This is the moment where you drop to a lower time frame. So we are now on the 4 hour. The 4 hour would become your higher time frame. And then you could drop, for example, to the 1 hour or to the 30 minute. And there you look for trading opportunities away from the spike into the new trend direction here. And it works really well. Here we have a breakout buildup, and I made videos about the breakout buildup in the past, and you can find them on my YouTube channel. They are always among the most popular and most liked strategies, because it's a trading strategy that can be combined with a lot of other trading strategies, and it really helps you find high probability trades. So step one is you want to find a market that is currently trading in a range. It can be a sideways range, it can be a triangle, it can be a wedge, a flag, any sideways consolidation. And you want to make sure that you are able to find very nice boundaries of the range. So here we have a great trend line to the downside here, and we have a great resistance level where we connect the highs, we get a perfect straight resistance level. And what you are then doing is you are waiting for a buildup. A buildup is where the price comes back into the previous resistance level, but is then not able to pull away. You can see previously the market was at the resistance here, here, and here. And every time the market was able to sell off quite dramatically and quite quickly and quite strongly. However, here, the market wasn't able to pull away again, and the market really stuck to the level. So this shows us that now there seem to be not as many sellers, and the buyers who probably previously sold are not selling anymore, and probably a lot of more buyers are loading up. And then you are waiting for the breakout. It's very important, once again, to not get into trades too early. You always want to make sure you are waiting for that market to actually break out of the pattern and also close outside of the pattern. And this is then here, this little area is the build-up here before the breakout. And you can find and look for the build-up in many different patterns. As I've said, here we have a triangle. You can see the market is coming from an uptrend here, making higher highs and higher lows. Then the market started to make lower highs. We are not able to make lower lows because you can see here we have a very nice previous resistance area that turns into support. We have lower highs, and whereas previously the market, whenever it touched here the support level, it was able to rally higher here, rally higher here. Here the market wasn't able to get away at all, and it really stuck to the level. So again, not a lot of buyers, probably more and more sellers are coming in. And then on the confirmed breakout, you can really see how the trend rolled over from an uptrend, from the consolidation into a new downtrend. And this is a great way how you can get into new trend following trades very early on. Breakout buildup in a range market. So we are coming here on the left side from an overall downtrend. So we're coming from the top left. Then the market is currently pausing, temporarily pausing So you'll find this very often. You have a downtrend, an initial downtrend, then the market is consolidating. The buyers and the sellers are just looking for a range market. They are unwinding positions. If you are short, you're probably thinking about taking profits. If you are looking to, if you are in a buying trade, you're probably also looking then to exit the trade. And this is also adding to a lot of selling pressure here. And if the market, or when you can see that the market is then coming quicker into such a level, whereas here the market rallied higher, came back, rallied higher, came back, didn't rally as much, came back and almost wasn't able to get away at all from the level. And then you have your breakout. Again, it's very important that you always wait for the breakout. Just because there's a buildup and the market is trading into the level sooner and sooner, it doesn't mean that you should automatically already get into the trade, because sometimes the market will just bounce and go the other way. But if you can see a breakout, and the breakout was initiated after a buildup, this is how you can really stack the odds in your favor. We have another example. Here we have a breakout buildup and a trap pattern. And I've included a few traps later on because I think traps are also among the most interesting patterns that you can find. So you are here in an uptrend. The market is putting in a temporary high. The market traded outside of the previous highs. So it looks like the market is actually making a continuation. But within the next two candles, the market not only goes back inside the range, but how does it go back inside the range? With a huge bearish candle. We can look left here, and we are not seeing that size of a bearish candle previously. Maybe here or here, but you can see it's a very huge outlier. So whenever you find those huge candles, especially if they are happening within a great context, here at the previous high with a failed breakout, this is what should really get your attention, and this should make you start following a market. Only because you see a trap, it doesn't mean you should automatically get into the trade, but it's the first heads up that something here is changing. And then the market is coming back into the level here. And whereas previously the market was able to rally higher, now the market isn't able to get away at all. You can see here we have a double top. The market is coming back into the level, and this time there's almost no reaction at all, and then the market really collapses here outside of the range. So you can see there's probably a lot of accumulation and distribution going on. The buyers who wanted to continue the market found out that there's a lot of selling pressure here. Probably a lot of people who previously bought are also unwinding their positions. And then you can see this is all adding to this huge pressure. And whenever you see, or not whenever, but very often when you see a breakout buildup with such an amazing context, you will often see that this is followed by a huge violent breakout move. And this is where you can really nicely find those big trading opportunities. Next is the bump and run pattern. And the bump and run is a very nice pattern that allows us to understand hysteria of markets, and we can often find those markets also among stocks, and we have seen it in crypto as well. And this is very nicely how we can really see the mass psychology. So here, when we are talking about a bump and run, we have different stages. It's always or often starting with a lead up phase, which is a general modest trend. The market is just moving higher slowly but steadily. There's not a lot of volatility. The market is moving orderly. And then comes a point where the market is really accelerating. So after a long trend, you can see suddenly something is really changing and the market is taking off not seen before. And it's really moving higher in a short period of time, quite a bit. But this is, we call it a bump pattern or the bump phase, and this quickly becomes unsustainable. We often see it in crypto, or we have seen it in crypto, where in the beginning the market was moving slowly and steadily, and then suddenly maybe there was news in the financial media and more of the mass has picked up about a specific market. They're flocking into the market, really driving higher the prices in a short period of time. But then it becomes unsustainable. Some traders start taking profits. Weakness is being shown here as well, and this is then often where it leads to the run phase, where everybody who has previously bought, and especially people who have bought early, are looking to take their profits because they've made already so much money, and they want to secure their profits, so they are scaling out, and this leads to more and more selling, and the more people sell, the more the price goes down, and this is just a is cascade, and this leads then often to a complete turnaround. Here we have a bump and run pattern together with a triple tap. And a triple tap, I've made 2 videos about a triple tap, I think, before, and there's just always so much interest in it. So later, as we go through all of our strategies, you will see more triple taps, and I'm going to talk about more about how to trade them, what they are, and how to find them. But again, we are starting here with the lead up phase on the left, a very moderate, normal trend here, and then suddenly the market is really accelerating vertically. So you can see this is taking off in a short amount of time. The market is really rallying higher. Then you can see we have our triple tap. So we have 3 consecutive higher highs, but each high, or the highs in general, are very close together. They are not really able to make new highs in a strong way, which shows us a little bit of exhaustion. And then you can see the market is breaking out of the pattern where previous resistance turns into support, and then we have a breakout, and not just a normal breakout. You can see within only 2 candles the market sold off what took previously dozens of candles to make for on the way up. So clearly a huge signal. And bump and runs are a little bit more advanced. They're harder to trade because your timing here is very important. It's very easy to be too early or too late as well, because those turnarounds and the sell-offs can happen very quickly. So they are a great pattern, but they may be a little bit more on the advanced side. So here let's talk about a triple tap combined with a divergence. So you can see the market is in a downtrend here on the left hand side, and initially the downtrend was moving quite quickly. So in a short period of time the market moved lower quite a bit. There were almost no consolidations, and then suddenly the market is starting to make a more of a consolidation. So it's trading sideways for a while, moving a bit lower, trading sideways again, and moving lower. So there are a few things that is really important here to note about that. First of all, you can see that the consolidations become longer, whereas previously there was just a very short consolidation. Now a longer consolidation here at point 1, a much longer consolidation here at point 2, and also the following trend following moves are becoming shorter. So whereas here you have a huge move, here you only have 2 candles, and here you have basically just 1 candle. So there are a few things that are showing us this fading selling pressure, whereas previously there was a lot of fading selling pressure here. Here, not as much anymore, and here definitely not. So we have 3 consecutive lower lows, lower low, lower low, lower low. But each consecutive lower low is showing us that this downward pressure is fading, and there are not a lot of sellers anymore. And of course, we can put our RSI 14 period here on the chart, and the RSI will confirm that. Very often you will see a triple tap is also coming with a divergence. It's just the natural rhythm of the market with the lows and the highs and how the trend is progressing that you will often get a divergence with that. Here we have a divergence reversal. So divergences are great. I always use the RSI with the default setting, which is 14 period. And what I basically look for are a few things. First, I always want to look for a divergence at the end or after a long trending market. So I always want to see that the market has been previously trending for a long time and also very strongly. Then I wait for the market to give me a very nice divergence. So here you can see we connect the lows of the market, low and low and lower low. And when we connect the lows on the indicator on the RSI, you can see that the indicator is starting to make higher lows. So the indicator and the price action are diverging. They are making 2 different and separate things. So when the indicator and the price action are not agreeing, that's a very big heads up. And it means that the trend, although it looks quite strong, it is not as strong anymore. So the indicator is able to look into the price action much deeper, and it's able to look into the candle size, the momentum, and the trending strength of the move here. And the indicator then provides you a little bit more of an objective way of understanding here the trend. And then what I look for is a way to define a breakout. So just because you have a divergence, obviously it's not enough to just get into a long trade, but you want to be able to time your trade. And the way to do that would be, for example, look for a pattern, look for a price level. So here we have a previous support that turns into twice resistance, and then here we have a breakout. So now the market is making a higher low. It's breaking out of a significant level that wasn't able to be broken in the past. So when the market is able to break a level that wasn't able in the past, this is a very important signal. And again, you can build a lot of confluence, stack confluence factors on top of each other to come up with more robust trading ideas. Here, a very similar situation. Again, we are starting with a strong uptrend. That's the first thing that you want to look for if you are trading any type of divergence, because divergences are generally considered trend ending signals or trend reversals. And you can see the market was in a strong uptrend. The uptrend then came to an end. The market tried to make a breakout here. You can see here was the previous breakout. Here was the breakout attempt, very similar to what we have seen on the trap pattern. So the breakout attempt was immediately rejected. It drove the price back into the previous support area. How does the market react here? Now once it is back here? With a build-up. Whereas previously the market was able to really rally away from the level, and a lot of buyers thought that this was a pretty cheap level. Now the market is sticking to the level, and you can see it's really clinging to the level. Before the breakout, it's really not able to move away at all. We have our divergence at this point already confirmed. Then we have a breakout, we have our pullback. So a few ways how to get into this trade is with a breakout, or if you missed the breakout, maybe you didn't like the initial breakout, maybe you were asleep or at a job or any way occupied, you could then use a pullback approach to still get into those trades. And then you can see the market really accelerated away from that. So this is how you generally want to look for a divergence. Let's try to find a last divergence and then we move on. So again, the first thing you always want to look for is a strong uptrend. Then you want to look for the uptrend to weaken. So the market did make a higher high, but the indicator confirmed and said that this is not a strong higher high. This is already a higher high where the price is showing signs of weakness. And how do you trade that? This is actually a trade that I traded. First of all, you define here your breakout area. So you define your support area. You look for, okay, how can I actually time the trade? You time the trade by defining a support area, and then all you do is wait for the breakout. So just because I mentioned it, this is the trade that I'm in, and this is what happened after I took the screenshot for the initial presentation. So the divergence was here. This is the breakout level that we defined. Again, we have a breakout buildup, and when we zoom in, you can see the market broke out of it, made a dirty retest. There's also here a trend line at the top, which was then being retested here. You can see that. So a dirty retest at the breakout level, and then you can see the market is now moving lower. Not a very strong fashion, so you probably want to at some point think about taking partial profits, especially if you see something like this where the market is having problems trading into a new low. It's not really a sign of strength. So a very, very nice turnout, and it all started with a divergence. So this is a great example of how you can use different tools and then combine it to come up with trade entries. So flags are probably among the most reliable trading patterns. Flags are considered trend following or trend continuation patterns. And on Pattern Alpha, we created a trading algorithm that trades different patterns. And among one of them is a flag. And what we have seen is that the flag is among the most reliable patterns. So let's take a look at a few flags and I will show you what they are and how to look for them. So a flag is best looked for during a trending market. So you want to make sure that the market that you're looking for is already in a trend, such as here. And what you then want to do is wait for the market to give you the flag. And the flag is just some type of consolidation. So the market always moves in those waves. I made a trend course on YouTube. I think it was like 2 weeks ago, so check that out. A trend trading course where I talk about the different trending stages. And you want to wait for the market to give you a consolidation. And if you have missed the first move, that's a great way to get into a trade later on. Or if you're already in a short trade, this is also a good opportunity maybe to scale into a trade more. And let's just compare what has happened. First, when the downtrend started, in a short period of time, the market moved quite a lot. So a very, very steep decline, very strong, obviously. Here, a lot of selling pressure. Then, is this really a sign that the market is ready to move higher? Not really, because you can see the market, although it did make kind of higher highs and higher lows, the way the flag moved is very weak. So the angle is very flat, is very shallow. And if you just compare the steep and the shallow angles and phases here, it should give you an indication of who is here really in control. The sellers are totally in control here of the market. The buyers are not really there. They try to make maybe move the market higher, but they didn't succeed. At no point were they able to get the price up quicker here. There was even a trap component, so the market tried to break out of this recent high, but obviously it failed, and it failed in a significant way with this huge rejection candle. And all of this indicates a continuation. You can also draw a support level here, for example, and then you have a little build up here pre-breakout, and you can see how we can nicely stack all of that on top. Continuation number 2, again, very strong breakout, very strong move here. So we are looking at a very strong uptrend. Then this is not a strong downtrend. This is a very, very weak move to the downside. In a long period of time, the market moved lower only a tiny bit, whereas here in a short period of time, the market moved quite a lot. So strong buying pressure, weak selling pressure here. And then you could, again, combine this with a breakout approach. You draw your last support or resistance in this case, you wait for the breakout, or you can even look for a retest here at this area. So a few options how you can approach it. Again, here at the bottom, we have our trap component as well. We can also add a higher time frame moving average. So now this chart shows the 1 hour time frame, and the red line is the 50 period moving average from the 4 hour time frame. So it's the 50 period from the next higher time frame. And what you could do is, first of all, you want to make sure that you only trade into the direction of the higher time frame moving average. So if the price is above the moving average, you only want to trade long. And you want to trade long when the market is coming back into the moving average. And you not only want to trade blindly, obviously, you want to wait for confirmation. So you want to wait for a flag at the moving average, and then you could wait for a breakout. Those are great pullback, trend following trading opportunities. Head and shoulder break and retest. So if you read one of those classic technical analysis books from Edward and McGee, for example, I think they classify head and shoulders as one of the most reliable patterns, and they are great patterns. And there are a lot of things that head and shoulders is telling you. First of all, they happen after a long trending market, and a head and shoulders is a so-called transition pattern where an uptrend leads to a downtrend, and the head and shoulders is really the transition where you can nicely see that the buying pressure is fading, the market is starting to make lower highs, and then on the breakout out of the head and shoulders, it's also making lower lows. And this never happened during the uptrend. The market was always able to make higher lows. Here on the breakout out of the head and shoulders, it's the first time the market is making a lower low. It's coming back, retesting the previous support now as resistance, which is a great signal here in and of itself. And then you can see afterwards the market is really nicely taking off. Head and shoulders could also be a continuation. So whereas in this example it was a reversal, so uptrend leading to downtrend, here the head and shoulders is what is connecting a downtrend here with another downtrending phase here. So it's in the middle between two downtrending waves. So it's a connector phase and a continuation. And what you want to do is you wait for the downtrending phase here to be over. You see that the market is trying to make a breakout attempt higher and a trend reversal attempt, but it seems like the trend reversal failed. There you can see the market started shortly afterwards making lower highs, and then after the market is also making lower lows away from the pattern, this is then how the market rolled over. So this trading strategy is a little bit more geared towards day traders. And what you do is, first of all, you usually use this on the 15-minute, maybe 5-minute time frame, and on TradingView, you can find an indicator that is called sessions. And in yellow, we have the Asian or Tokyo session. And in green, we have the London session. And what you will often see is that if the market has been in a range for an extended period of time, you can then wait for the market to give you a breakout in the London Open. So here you can see this overlap period. This is where the London period started. This is when the London Stock Exchange opened. And this is also where you see the breakout. And this is often foreshadowing a complete trend reversal. If you can see a strong breakout early on in the London session or here within the first candle of the London session, this is usually a very, very high probability trade. Here as well, the market was trading sideways for an extended period of time. Here was the London open, but here you can see then shortly, just like 2 or 3 hours after that, you can see that still early on in the London session, the market then really broke out of the pattern and started a downtrend. So London breakout patterns are very, very important strategies and signals, especially for day traders. This is something that many traders are always interested in. I made videos about this in the past. This is a moving average channel. So I use 2 moving averages. Both are the 20 period. One is applied to the high, one is applied to the low. And then you have this channel, and the channel can never cross. It's always going to be a parallel channel. And what you want to do is, first of all, you want to wait for the market to give you a range market, because if you have a range market, timing trades is much, much easier. All you have to do is just wait for the market to break out of the range, and then you can use the moving average or the channel to ride your trades. And you have a few options. First of all, you could have your exit when the market is dipping back inside the channel, or you're waiting for the market to cross on the opposite side. Sometimes the cross will not give you a favorable exit on the like here. Sometimes the cross will also give you a worse exit. So it's not better or worse. There are just a few pros and cons, but the moving average channel is a great way to have an objective way to ride your trend. So if you have problems staying in winning trades long enough, try giving this moving average channel a chance. And we can often combine the moving average channel with other setups. So here you can see we have a very nice channel. We have a triangle or a wedge. We have a support level. We wait for the market to break out of all of this. And then you can see you can use the moving average channel here to ride your trade all the way down. Sometimes you will even find re-entry opportunities when the market is dipping inside such a channel and then moving away. So here you can see you could probably draw in another rectangle box and then trade the continuation after rejection of the channel. Deceleration. I made videos about deceleration because this is one of my favorite setups that I trade a lot. And this is a trade that I highlighted in one of the previous YouTube live streams and also for my students. And it worked out very, very nicely. And we are starting here on the higher time frame, daily time frame, and you can see the market was in an uptrend, a very strong uptrend. This is Forex. So we are using the mean reversion concept of Forex. And when you see a long trend, you want to wait for signs that the trend is slowing down. And the slowing down came here in form of a pin bar. A long trend, and in the long trend, you then see a pin bar. This is where I go to a lower time frame, such as here. We go from the daily to the 2 hour. Then we look for a trend line, for example. You can connect the lows. You'll see a head and shoulders, the left shoulder, the head, the right shoulder. You will even have here components of a build-up, whereas previously the market's sort of higher. Here the market was really sticking to the level, and then here you have your breakout out of all of this. So this was a trade that I highlighted in YouTube Live, also for my students, and this is a perfect higher lower time frame, multi-time frame trade. Here this even works on crypto. So now we are on Ripple. This is the weekly time frame. The market came back to the weekly 50, gave you this deceleration. On the lower time frame, we are able to condense and confirm that the market is trading in a range. Wait for the breakout, pull back, and then you can see afterwards the market took off. And it all starts with those higher time frame decelerations. If you can find a deceleration with some context, like here on the 50 period moving average, even better. So let's talk about a central pivot point strategy, and you can either use the daily pivot point or the weekly. I am using here the pivot points, traditional weekly. So this is the weekly pivot point here. I hit all other pivot points, so we're only looking at the central pivot point. And what you want to look for is a trending market. So the market is already here in an uptrend on the left. It is coming back and trading into the pivot point. And we want to look for long opportunities. We want to go with the long-term trend. We're going to go with the trend that has already here been exhibited. And we can do that by using the pivot points. If you see that the market is really struggling and is not able to get below the pivot point, this is a clue that you can then try to time your trades with the trend away from the pivot point. And And here you can see the market is coming from a downtrend. It is trying to break above the pivot point. It is being rejected, and then the market is really accelerating down. And the next period, the next day, this is the daily pivot point, the market is coming back into the pivot point, is being rejected and moving lower again. So you can often see those break and retests of the pivot points. They are great trading opportunities. We could also add other tools on top of that. So we are looking here at the weekly pivot point. The market is in a downtrend, broke below the weekly pivot, comes back to it, retests it from underneath, fails to keep or stay above this, and then falls lower, comes back into the pivot point, fails to break above it, and continues lower. And now we could add other tools on top of that. So for example, we could add a Fibonacci or just horizontal support and resistance. So here on the first example, we are using here the support and resistance level. So previous support is turning here into resistance, and that is a great confluence factor. Or we can also draw then later our Fibonacci from point A to point B, and you can see we get a perfect 50% Fibonacci retracement. So what this means is that we have not only a central pivot point here or here, we have multiple areas of confluence. We have a Fibonacci and also a previous support that is turning into resistance. And again, if you can add confluence factors or stack confluence factors, so you're not only looking at a moving average, you're not only looking at a pivot point, you're not only looking at a trend line, but you have multiple confluence factors, multiple tools, concepts that all point to the same trade direction and trade idea. This can often enhance the probability of finding great trading opportunities. Trendline breakouts next. I love trendline breakouts. I've traded them for numerous years. And the most important thing about a trendline breakout is that you're looking for a valid trend line. This is something that many traders get wrong. A valid trend line has 3 touch points, not 2, but 3. And this is very important because with a trend line, you can connect any 2 random price points, but only if you get the third one, you actually have a valid trend line. And here we connect the high and the high and the high, so we have a valid trend line. And what you are doing is you're simply waiting for a breakout out of the trend line. And this is often you are then often able to trade new trends very early on. A trend line breakout is really the signal that the previous trend, in this case a downtrend, is on the breakout, leading to a new trend. We can also then add another tool. So we are looking for the last swing high. So here you can see we have nicely defined the last swing high of the downtrend. And on the breakout, you can now see that the market is making a higher high. So as previously you have lower lows and lower highs, the trendline breakout is really the first sign that the market is making a higher high. And by that, it has also already made a higher low. And you can even see we get another signal here, the retest of the previous highs now becoming support. So we can really nicely understand so many things about this chart by just using 2 or 3 different tools. The second way of using a trend line is using a trend line for a trend line pullback strategy. So what we are doing here is we're looking for a trend line that is valid, so 1, 2, 3. And once you have your third touch point, you are then looking for trading opportunities away from the trend line. So this is more of a trend continuation, whereas the trend line breakout is considered a trend reversal. So you're looking for trades away from the trend line. So here, for example, what we could do is after point 4, we are looking for a breakout, and we always want to wait for the market to break out of a range above a previous support and resistance level. And we have that here. The market is having this previous resistance level, and on the breakout you can see this is where the trend really accelerated. So don't trade within those ranges, really wait for the market to get out of them. So here we have 2 things coming together. We have a trap and a build-up. So the market was in an uptrend. We have a triple top here and then a breakout attempt. So here you can see we have a little candlestick that was poking out above the previous highs. And how does it look? Imagine how does it look when the candle was forming. When the candle formed, it looked like the market was ready to break out into a new high, but within the same candle, the market was rejected, the buyers were rejected, the price is back inside of the range, so this is the trap component. It's already our first hint, or maybe the second hint after the triple top. So a triple top obviously is already a sign that the market is not able to break into a new high quickly. The failed breakout attempt is then set up a signal number 2. And then you can see the market is coming back into the previous support. And whereas previously the market was able to rally higher quite a bit, now the market is back at the level here, but it's really sticking to it. It's not able to pull away at all. And then you have your breakout with this huge candle here. So you have multiple things that you can stack on top: triple top, trap, breakout buildup, and the huge engulfing candle as a breakout. We have a trap reversal. Again, once a very, very nice setup after a strong uptrend. The market tried to break out higher. It did close out here with a strong breakout candle. And the last thing that you want to see on a breakout candle, on a strong breakout candle, is that the next candle is a strong reversal candle. So a great trap pattern. And you can see then the market broke out, retested the previous lows now as resistance, and the new the trend was initiated. So we have another form of a continuation. Besides flags, we can also use triangles. And again, you want to wait for the market to be in a trending stage. So here the market is in an uptrend. After being in a downtrend, it topped out. It broke out of this pattern, started an uptrend. Then what you do is you wait for the first consolidation. And if you can define a consolidation within such a nice frame, then you can use that going forward. In this example, we could use, for example, the break and retest approach. So we wait for the market to get out of the triangle. And then you can also wait for the market to retest this area. So maybe you didn't like the first breakout. Maybe the breakout was too strong. Maybe you were not just there. Then not always will there actually be a retest, but sometimes there will be. And that's a great opportunity to then trade those patterns as well. We can also use a triangle together with a moving average. So here you can see we are using the 50-period moving average in red, and the price is above the moving average. So this means that we are in an uptrend, we are in a bullish market, and therefore we want to look for buying opportunities. And we want to look for buying opportunities with strong momentum. And the highest momentum is usually found outside of a range. So we wait for the first trending phase to be over. We wait for the market to enter here a triangle sideways phase. And then if the market is able to break above the previous highs, that is where you can find good trading opportunities once again. Let's talk about triple taps, and they are always one of the most favorite patterns of you whenever I do a YouTube video. So I previously just basically briefly explained what are triple taps. Triple taps is a trend reversal pattern. And a triple tap are 3 consecutive lower lows, and each subsequent lower low is showing you more weakness. And you can see the market is here in a downtrend. Initially, the strong downtrend then faded. The lows are becoming weaker and weaker, so each low is not able to pull lower as much. Between the lows, you also have stronger and stronger consolidations. Here in this example, you even have point number 4, a build-up. So we are able to define our triple tap with this trend line here at the top. And you can see we have a beautiful breakout build-up together with the triple tap. And then on the breakout, this is really where you see then the strong change of the market sentiment. Here, the example from previously, we can also use a divergence. Pretty much all of your triple taps will also have a divergence. It's just the way the triple taps work, because each subsequent lower low is weaker and also the consolidation is stronger in between the lows. This automatically will give you a divergence. So if you're just starting out with triple taps, you could add the RSI 14 period, and it will help you to find the triple taps a little bit more objective. Triple tap number 3. Here you can see we have 3 lower lows. We are in a strong downtrend initially, but then you can see that the downtrend is slowly fading from here to here to here and here. The lows are becoming weaker. The price is almost not able to push into a new low. Here you can see this is the first time the market is then also making a higher high, whereas previously the market was always able to make lower highs. This is the first time the buyers are so strong that we are getting a higher high. Then you can see we even have a retest of the previous breakout area. Retests are very, very common, as you can see here during this video. They happen all the time. Then you can see this is really where the market took off. So the triple tap is your signal or indication that the trend that has been going on is weakening. And then you can look for signs for breakouts, pullbacks, and those are often help you time trades into the new trend. So now I've prepared a quick Q&A with the most common strategy questions. What are questions that I get on a daily, weekly basis when it comes to trading strategies that you need to consider? But first of all, let me just briefly point your attention to a very, very special offer. So I've been trading for around 14 years. I've mentored hundreds and hundreds of traders, and right now I've created a very special trading strategy pack. So if you would like to learn the strategies, the trades, the entries that I take on a daily basis, make sure to check the link in the video description below. Right now you get 4 trading courses for the price of 1. So you get my price action course, and I included a supply course, a daily bias course, which is a multi-time frame trade strategy. And if you're new to trading, there's also a Forex starter course. And I've included a lot of trade studies with entries, exits, where do you put your stops, how do you manage your trades, what do you do with weekends, what do you do with news, and all of the things that you need to answer when it comes to having a professional trading strategy. And for those of you who like to have a little bit more of a hands-on approach to becoming a better trader, we also have a Forex mentoring group. So Moritz and I, we run a Forex mentoring group where as a live chat, we hold between 5 to 6 live webinars every week where we go through the actual trades, the charts that we are looking at. We explain what we are trading and how we are trading it. We're also going to review your trades of one of our mentees, and we have a lot of special webinars as well. So it's a great, fun community to be part of, and we are all learning and growing towards the same goal. And the first question that I always get is, should I trade one strategy or many strategies? And my answer is always that you start with one strategy in the beginning. You try to learn a strategy, you try to master it, you try to understand it fully. And once you have done that, once you have a good idea of what the strategy is all about, how to trade it, what to look for, then you can slowly add more and more strategies to your repertoire if you still feel this is needed. I always bring up this story from the hedge fund trader that Moritz and I had dinner with a few years ago in Singapore, and he said that he's only trading a Bollinger Band spike reversal, and that's all he does in the hedge fund. So maybe you don't even need too many strategies, and maybe focusing on one strategy only is going to be all you need. This is what I keep seeing more and more among traders. Which is the best strategy? So now I've just given you a video with 23 strategies and which is the best one. And the purpose and the goal of this video is that I want to open your eyes for what is actually out there. What are the different tools? What are the concepts? How do you look for, or what are breakouts? What are reversals, trend continuations? And when it comes to choosing a trading strategy, traders are very different, obviously. The way you look at charts is going to be different from how I look at charts or other traders. They're just concepts or things that make more sense to you versus another trader. So the goal of this video is that I show you and I give you options, and I want to give you alternatives so that you can really see, okay, what is making sense to you? What is the strategy that you naturally feel drawn to? And then this is where you can start. So find something among the video and the strategies that I've just given you, and whatever makes sense to you, start with that. Market or limit orders, how do you trade it? So personally, what I do is I only use market orders for my entries. So as I've said many times during the video is you need to wait for the breakout to actually happen. And one of the biggest problems for amateur traders is that they are impatient and they are maybe able to see the head and shoulders, they're able to see the flag, they're able to see the rectangle, the triple tap, but they cannot wait long enough, and then they will get in too early. And what I have found over the years is that if you can really work on your discipline, if you can really work on your patience, market orders and only trading outside of a breakout, that is often giving you a much, much higher win rate. how do you find your perfect fit? So how do you find a strategy that really fits to you? And Moritz and I, we did a podcast with Dr. Steenbarger, which is who is one of the most sought after trading psychologists. And he said the number one predictor for trading success is curiosity. So what I always recommend to the students and the traders that we mentor is also to try around, play around with something, and play around and really pay attention to how you feel. How do you feel trading a triple tap? How do you feel trading a reversal? How do you feel trading a breakout versus a pullback approach? What feels better to you, higher or lower time frames? And the goal is here that you try different things, but you're not mindlessly system hopping. You're really paying attention to what makes sense and how do you feel, what feels good to you and what is not feeling as great. And then over time, you can get a feeling for the type of trader that you are, the type of psychology that is inside of you, and then you can make better decisions. What is the best time frame? I have to include this because I get this question probably every day a few times. And the best time frame is the one that you are suited with, but also the one that is can be combined with your daily life. So for a trader who has a 9-to-5 job, and if you're very busy, usually the lower time frames don't make too much sense because during your workday you probably won't be able to trade the 5-minute time frame actively. So for those traders, usually a swing trading approach, 4 hour, maybe the 1 hour if you can watch your charts every hour at least. Daily time frame, those are the right options. Or if you maybe are a shift worker and you occasionally have a few hours during the day, you could think about trading a day trading strategy on the 5-minute time frame for 2 or 3 hours a day or on given days. So the perfect time frame really depends on your personal situation and your time availability. And that's it. I think this is a great way to wrap this up. I hope you enjoyed the video. I hope you got something out of it. Let me know in the comments which of the strategies you find the most interesting. What are you going to try out? What are the results in the past that you had? Really let me know. I look forward to that. And until the next time.